Before we start this video, do like and subscribe to our channel and not miss on any updates.
Now, friends, let us understand the meanings of these words. Reconstruction, internal reconstruction. So, what does it mean? So, just imagine at our home, we have dining table, say it's here, then sofa set is here, chairs are there, like this, different aspects of furniture are at different places at the home. Now, sometimes what do people at home do? We might kind of change, maybe let dining table go there, let sofa set come here. So, you make some sort of rearrangement, right? So, reconstruction is also some form of rearrangement that is happening in the company. But why does this kind of rearrangement happen? We understood that when the company has losses and if it wants to remove those losses from the balance sheet, clean up those losses from the balance sheet, the company may say, okay, if this loss is gone, correspondingly there might be reduction in the share capital, reduction in say debentures or creditors, etc. So like this there might be reduction in other items. With this, let us clean up the loss whatever the company has. So something like that can happen, right? So friends, in internal reconstruction, there will not be, I am now clubbing towards, reconstruction is basically rearrangement. Now internal reconstruction, when I say internal reconstruction, is one where this kind of rearrangement is happening within the company without any liquidation of company. We are removing losses from the balance sheet, we are reducing share capital and other debentures, creditors, etc. But are we liquidating the company? No. So we are reducing those amounts to clean up these losses, but we are not liquidating any company, we are not starting any new company, etc. Right? So this process is what we call as internal reconstruction. Alright. Now let me give you another example of what we mean by external reconstruction. Accounting for external reconstruction is done in a separate chapter. But just for you to know, what is the difference between internal and external reconstruction? Say, actually this is a case study which has happened in the past. There was a very popular toothpaste company. I will not name that company. There was a very popular toothpaste company. There was one multinational toothpaste company which wanted to enter India. Now what this multinational company has done is, it found out, oh, I think a lot of people use this local toothpaste, but I want people to use this toothpaste. So what that company has done is, it has gone and slowly started spreading some news that in this local toothpaste there is some bone powder. Now suddenly people said, oh my god, if there is some bone powder, I wouldn't want to use that as a toothpaste. So suddenly people stopped buying the toothpaste and people started shifting gradually to this MNC company's toothpaste. Now listen carefully. This company, which was the local company, what it has done is, it said, oh, this toothpaste brand is now gone. Even though the company has the factory, even though we know that we don't use bone powder, people have a perception. People have a perception, means people's impression is we use bone powder, and even if we tell that we don't use bone powder, people are not listening to us, they are not believing us. So what this company has done is, all the assets and liabilities this company transferred to a new company. Think about it. All the assets and liabilities this company transferred to a new company, and this old brand was gone. Say old brand was A, that A was gone. Now there is a new brand called B. They started selling toothpastes in the name of that new brand B and in a new company, right? So that is what is a great example of external reconstruction. So what has happened in external reconstruction? Existing company closed down, new company got created, right? So existing company got closed down, new company got created, fresh capital was infused. In fact, into the new company, fresh capital was infused. But look at what was happening in internal reconstruction. In internal reconstruction, it is not about capital being introduced. The existing capital which was there was also being reduced in the internal reconstruction, right? So quickly friends, if we have to summarize, in internal reconstruction there is no liquidation. In external reconstruction there will be liquidation. Then in internal reconstruction there will not be any new company coming into existence, But under external reconstruction, a new company would be incorporated and that might come into existence. Then in internal reconstruction, the capital position generally will come down. The capital, share capital will reduce. We call it as capital reduction. That may happen. But in external reconstruction, there wouldn't be reduction, but sometimes there might be fresh capital infusion.
Action.
Friends, under internal reconstruction, we have 5 broad categories. The first one is called alteration. Okay, alteration of share capital. We will understand what that is. Under that alteration, we have 2 subcategories. The first subcategory is called as splitting of shares, and the second subcategory is called as consolidation of shares. So we will understand with problems as to what those categories are. Okay, so the first one is alteration. Then there is something called variation of shareholders' rights. So we will understand about what those variations are. And then we have something about this reduction of share capital. So what do we mean by reduction? All those things, see, all these points we are going to discuss in detail. After reduction, we have something called as this compromise, and basically these are compromises or arrangements as we call them. So that is the next category, and the last one is called surrender of shares. So these are the 5 categories what we have, and friends, what we are going to do is we will start with alteration of share capital and we will see a few problems before moving to the next one. Friends, we are now going to discuss about alteration of capital, and in alteration of share capital I told you there are 2 categories. One is called as splitting of shares and the other one is called as consolidation of shares, right? Concentrate carefully. It will take 5-10 minutes to get clarity on logic, and I will take small examples. There is a company which has, say, this is shares and this is face value, this is paid up value. The company has 1000 shares and face value is 10, paid up value is also 10. Now what the company wants to do is each share of 10 rupees the company wants to split. So something like this, say there is one share. If the company wants to split that share into 5 shares, so 1 will now become 5. Okay, so here each share of 10 rupees what the company has, it wants to split into 5 shares of rupees 2 each. Now say we have a 10 rupees note. We took the 10 rupees note to a shop and we in turn got 5 coins of 2 rupees each. Did your income, did your wealth increase or did your wealth decrease? No. The same way, if share split or consolidation happens, wealth will not increase or decrease. Share capital will not increase or decrease. I have 2 rupee coins, 5. I gave those 5 2 rupee coins and took 10 rupee note. Will my wealth increase? No. I have one 10 rupee note. I take it to a shop. I give that 10 rupee note and take 5 2 rupee coins. Will my wealth increase or decrease? No. The same way, because of share splitting or consolidation, there will not be any increase or decrease in the wealth of shareholders. However, there is one small interesting thing which will happen. Listen carefully. If there is an item like shampoo, that shampoo is like a 10 rupee bottle. Maybe if it is a 10 rupee bottle, some 10 people can buy it. If that shampoo is available, same amount of shampoo, you equally divided that into 5 components or 5 pieces and made it into 2 rupees packets. There are 5 packets, 2 rupees each. Maybe earlier there were fewer people who could buy the 10 rupees packet or 10 rupees bottle. Now because it is available in 2 rupees, maybe more people will have the capability to buy that. Correct? So the same way, on account of splitting of shares, the only possible benefit what we can see is the number of, particularly if the share is traded in the stock market, the people who will be able to buy that share can increase. Alright, so if you keep that point aside, there wouldn't be any further change. Okay, come on, let us do that thing here. Here, face value from 10 became 2, paid up value is 2, and this share, can you say 1000 shares? No, it can't be 1000 shares. Now it will be 5000 shares. It will be 5000 shares. So this is what you mean by splitting of shares. Friends, now let us look at a problem from the study material. A company with a capital of rupees 10 lakhs divided into 10,000 equity shares of rupees 100 each, on which 75 is paid up, decides to reorganize its capital by splitting one equity share of rupees 100 each into 10 such shares of rupees 10 each. Excellent. Now let us look at how we have to solve this. What is the information given? Currently the company has 10,000 equity shares, and what is the face value per share? 100 rupees is the face value. What is the paid up value? 75 rupees is the paid up value. So in the amount column, what should you write? Should you write 10,000 into 100 or 75 into 10,000? Friends, we should write 10,000 into 75 for the purpose of balance sheet total. Listen carefully. In the journal entry, you will write in the amount column only the paid up portion. Authorized capital, issued capital, subscribed capital, those amounts will not come into the journal entry. Okay, remember this point. So how much will this be? 7,50,000. Excellent. Now what is happening? What is a reorganization? See, reorganization is something like this. Total will remain same, some numbers breakup will change. So first thing first, without any doubt I am writing that total after reorganization also is going to be 7,50,000. Now come to the number of shares. Each share is becoming 10 shares, right? One share will become 10 shares. So for number of shares, what will happen? 10,000 into 10, which will be 1 lakh shares, right? So this will become 1 lakh shares. Come to face value. Face value, now it will be 100 by 10. So write that 100 by 10, which is equal to 10. Then 75 is the paid up value. 75 by 10, which is 7.5. So here you have two numbers, 1 lakh and 7.5. 1 lakh into 7.5 is 7,50,000. Earlier 10,000 into 75 gave you 7,50,000. Friends, this is what happened in terms of splitting of shares. Total or the amount column hasn't changed, the breakup has changed. But how do we write this in the form of a journal entry? Let us understand that. Okay, friends, whenever you talk about journal entry for issue of shares, the discussion right now is about splitting shares, but let us just go one step back. If shares are issued, what is journal entry we pass? Bank account debited to equity share capital account. Okay, bank account debited to equity share capital, you might write that amount, whatever, 10, 100, 7,50,000, whatever it is, you will write. Now if equity share capital balance should come down, then what should you do? See, when you are issuing shares, you are crediting the share capital. When that amount should come down, what should you do? You should debit that account, right? So applying the same logic, what we will do now is equity share capital. What is the amount? Face value 100, paid up value 7.5. That account you will debit. Debit with what? Debit with 7,50,000. And what will you credit? What is now getting created? Shares of 10 rupees face value, 7.5 paid up are getting created. So you will write 2 equity share capital, face value 7.5. No, face value is 10, paid up value is 7.5. Right? So that is earlier. Acha, earlier also we wrote 7.5. No, earlier it was 75. Now it is 7.5. So paid up value 7.5. Account with same 7,50,000. So total has not changed, but just the breakup has changed. Now let me tell you one point. In real life, nobody will pass a journal entry for this. For exam purpose, definitely you should pass a journal entry for this. Okay. So for exam purpose, you have to pass a journal entry for this to explain how the splitting of shares is happening. But in real life, the impact will only come into balance sheet disclosures. The amount is same, the breakup will change. So in the note to balance sheet, you will give this point as to what is the number of shares and that they got split, etc. Nobody will write journal entries. See, it is important as a chartered accountant or even as a student of chartered accountancy, you should know what is required for exam, but do we do exactly the same thing in real life or maybe a small difference? The small difference is logic. What you are learning here should be remembered and the impact of this logic should be given directly in the balance sheet. You should not ask your client to pass a journal entry for this, right? Friends, now let us understand consolidation of shares. Consolidation is the opposite of splitting of shares. If I have a 10 rupee note and if I want to divide that into 5 coins of 2 rupees each, that is called as splitting. Now you have 5 2 rupees coins and you want to give all those things away and take one 10 rupee note. That process is what is called as consolidation. So say if you have 10 rupee shares, right? So each share that you have is 10 rupees. You have 10 such shares and the company says, hey, you return 10 rupee shares what you have. If you return 10 rupee shares, we will give you one share of 100 rupees. That is what you mean by consolidation of shares. We will look into an example and understand how the accounting entries have to be passed. On 31st March 2011, B Limited had 20,000. So what I want you to do is, as you read the problem, just make a small table. The information what is given, try to put into that particular table so that you don't have to read the question too many times, okay? So whenever you are reading questions regarding internal reconstruction, this is a good habit what you can form. So write in one column the date, then in the next column number of shares, then after that face value, paid up value and amount, okay, right. So make all these different columns. First, what is the date that you have? 31st of December 2011. B Limited had 20,000. Come to the number of columns, number of shares column, 20,000 shares of 10 rupees each, that is authorized, and the shares were all issued on which 8 was paid up. So see, automatically all those numbers you will get. In paid up column, please write 8. Now friends, we have 20,000 shares, face value 10, paid up value 8. In the amount column, what will you write? We already discussed this point. So in the amount column, we will have to write this number of shares into paid up value. Come on, write this. That comes to 1,60,000. That you have written in the amount column. Right. Continue reading the question. In June 2012, okay, come to the date again. So in June 2012, we don't know the date. So let us write 1st June 2012. We don't know the date, so I am just writing 1st June 2012. The company in general meeting decided to subdivide each share into 2 shares of 5. Okay, subdivide. Each share will become 2 shares. Okay, then what will happen? You have 20,000 shares. 20,000 shares will become how many shares? Now you know enough about this calculation. 20,000 into 2, 40,000. Right. Then continue reading. Of 5 with 4 paid up, obviously, so this will be 5 and this will be 4. Again, friends, your overall cross checking is this: how many shares we have? 40,000 shares. What is the paid up value? 4 rupees is the paid up value. This into this, 1,60,000. So think about it, friends. Will amount column change? Amount column should not change if it is just splitting or consolidation of shares. Continue. In June 2013, okay, come back to the date column. June 2013, we don't know on which date of June, I am just writing 1st of June 2013. Now what has happened? The company in general meeting resolved to consolidate 20 shares of 5, rupees 4 paid up into 1 share of rupees 100 each, 80 paid up. Interesting. Now 1 share earlier got split into 2 shares. Now what is happening? The company wants to consolidate all the shares. 20 shares will now become 1 share, right? So if you have 20 coins of 1 rupee each, the company is saying you return all of that, I will give you 120 rupees note, something like that. So each share, what the shareholders have, they have to put together all those shares and then consolidate them, give these away to company, company will in turn give new shares, but new shares have a different face value. Okay, now come to this. 40,000 is the number of shares what we had earlier. Now 40,000 divided by 20. So do that calculation. 40,000 by 20. Do the calculation properly. 0, 0 gone, and this will be 2,000 shares. So you will have 2,000 shares of, come on, what is the face value? Face value is 100. Paid up value is 80. Now come back to your calculation. Friends, 2,000 shares into 80, the way we did the calculation earlier, 2,000 into 80 is how much? 1,60,000. Chartered accountants, this is the point what you need to understand with this problem. Whether you do splitting of shares or consolidation of shares, it is only an arrangement happening internally within that category, but the outside total amount is not changing, right? Now we already learned journal entry for splitting of shares. The opposite of that, if you do ulta, it will become consolidation of shares. Let us see how that happens with the journal entries. We have to pass journal entries for splitting of shares. When did the splitting of shares happen? In June of 2012, shares got split, right? What is journal entry for that? Equity share capital account. Now, what was the face value of those shares? 10 rupees face value became 2 rupees face value, correct? No, 10 rupees face value became 5 rupees face value. So, 2 equity share capital rupees 5 account. So basically from 10 rupees we brought the face value down to 5 rupees, right? Is the amount changing? No, amount is not changing. 1,60,000, 1,60,000. In the brackets, if you want, you can give even the paid up value, but that is fine. But friends, in the narration you should clearly write being, come on, explain what has happened. Being, how many shares? Earlier how many shares we had? Look at the table what you made. Earlier we had 20,000 shares. Now from 20,000 the shares are becoming 40,000. Earlier 20,000 into 8. Now 40,000 into 4. That's exactly what we need to write in narration. I know some students who keep remembering narrations. Hey, don't do that here, come on. Narration is something that you have to see the journal entry, understand the logic of journal entry, and for a 5th class student, if you have to explain, oh, this is what has happened. So for that purpose, you have to write in some simple words what exactly that journal entry reflects. Okay, so what has happened here? Being subdivision of shares. I can also call this as splitting of shares, subdivision of shares or splitting of shares. How many shares? 20,000 shares of rupees 10 face value, rupees 8 paid up value became, see in simple language we are writing, became, how much did they become? 40,000 shares of rupees 5 face value and rupees 4 paid up value. Wonderful. Whatever marks the examiner wants to give you for this journal entry, full marks you will get. So in simple words, give the narration. Okay, right. Now, moving on. In June 2013, what has happened? Consolidation of shares happened, right? So come back to the table. Just now we saw the splitting of shares. Consolidation of shares. 40,000 shares became 2,000 shares. Earlier it was 40,000 into 4. Now it is 2,000 into 80. Let us write the journal entry for it. So equity share capital, what is the face value? Rupees 5, right? This is what you are basically debiting. Okay, this you are debiting. To equity share capital, which account are you crediting? Rupees 100 account is what you are crediting. Is the amount changing? It will not change. I will not talk about it again and again. Now you all understood that amount is not changing. It is 1,60,000 only, and you will write a narration. the way we just wrote narration for that entry where we said being subdivision of shares, we said. Here what will we write? Being consolidation of shares. Write down. Being consolidation of shares. What consolidation happened? 40,000 shares of rupees 5 face value, rupees 4 paid up value became, what did they become? They became 2,000 shares of rupees 100 face value and rupees 80 paid up value. That's all. Friends, from this table what we just analyzed now, we are going to understand the balance sheet presentation every year. Say in the first year, say look at that first year, that is 2011. If you prepare and present financial statements up to that particular date, how will that look in the notes to accounts? Friends, what we should do is, for share capital, authorized share capital requires a separate disclosure. That is a requirement of Companies Act. Okay, so as per schedule 3 we need to give separate disclosure requirement for authorized capital. So we will write how many shares at that time, 20,000 shares. What is the face value? 10 rupees is the face value. 20,000 into 10 rupees, 2 lakhs. That is the authorized capital. You will write that and draw 2 lines below that, meaning it will not go into the total. That will not go into the balance sheet total. That is what I mean. Okay, right. After that, issued subscribed capital. Issued and subscribed capital. How many shares are issued? 20,000 issued, subscribed 20,000. 20,000. Now, is everything paid up? No. So here you should write in the note, issued and subscribed capital, you will underline that and say, for that, what is the amount paid up? 8 rupees is paid up, right? So you should indicate issued and subscribed shares, under that 20,000 shares of rupees 8 paid up, and in the final amount column you will write 1,60,000. Got it? So this is how you are supposed to prepare and present the financial disclosures for the purpose of balance sheet. Now come to the next year. After splitting of shares, what will happen after splitting of shares? From 20,000 the shares went up to 40,000, but from 10 rupees of face value the shares came down to 5 rupee face value, and 8 rupees paid up they came down to 4 rupees paid up. That's it. So at suitable places change in the next year for the balance sheet purpose, and you know how the disclosures will look. Will the amount change for authorized capital total? No. For the entire issued and subscribed paid up portion, will that amount change? No. That's all. So internally only the change is happening. I hope you got that. Similarly, when the consolidation of shares happened also, simply what you should do is, instead of 40,000 shares, they became 2,000 shares, right? So instead of 5 rupee shares, they became 100 rupees face value shares. Instead of 4 rupees, they became 80 rupees paid up. That's all. Those numbers you will plug in, and next year's disclosure requirement for the balance sheet purpose is also ready. As I told you, in real life, the impact of this splitting of shares or consolidation of shares will be seen only at balance sheet level in this manner. Friends, as per Companies Act, within 30 days of such alteration of share capital, the company has to give a notice to ROC intimating that such alteration has happened, right? So this is a procedural point. And also remember, in the memorandum, you will give the breakup. Basically, you will indicate what is the value of share, what is the face value of shares, how many shares.